In a financial climate where every move matters and timing can define your future, the question at the forefront of many investors' minds is this: should you wait for a higher rate? Across markets, from traditional banks to digital assets, holders are weighing their options, questioning whether the current returns are enough, or if the promise of higher yields just around the corner is worth the risk of waiting. It's a decision that demands more than just gut instinct. It requires a breakdown of market signals, economic policy shifts, and the psychology of risk. Over the past several months, rates have shifted in ways that have kept analysts on high alert. Central banks, particularly the Federal Reserve, have taken a more cautious tone, signaling that the era of aggressive hikes may be tapering off, but not entirely. Inflation, while softening in some sectors, remains stubborn in others. The labor market continues to show resilience, adding complexity to the rate forecast. In such an environment, speculators and long-term holders alike find themselves caught in a loop of hesitation. Do you lock in what's currently available, or do you wait and hope for a bump that might never come? Financial strategists are divided. Some argue that current yields, whether in fixed income instruments, savings products, or even staking platforms, represent peak conditions. According to them, markets have already priced in the most likely outcomes. Any additional rate hikes, they say, would be marginal at best, and the risk of missing the window could outweigh the potential upside. Others caution patience, pointing to macroeconomic data suggesting that inflation could tick upward again, forcing monetary authorities to tighten further, pushing rates higher and rewarding those who waited. It's not just about where rates are, but where they've been and how quickly they've moved. Historical context plays a crucial role here. In previous tightening cycles, those who waited for absolute peaks often miss them. By the time the data confirms the top, the best opportunities have already evaporated. Market behavior is anticipatory. The best returns often go to those who can act just before the peak, not after. That reality makes this moment especially volatile for holders. Wait too long, and the tide could turn without warning. Act too soon, and you might leave gains on the table. Another layer to this equation is liquidity. Higher rates may sound attractive, but they often come with reduced flexibility. Committing to a longer-term instrument to capture a slightly higher yield could mean being locked in while more dynamic opportunities pass by. That's especially critical in fast-moving environments like the current one. The cost of illiquidity must be balanced against the promise of incremental gain. For holders, especially those with significant capital at play, that trade-off is increasingly central to decision-making. Corporate earnings, global economic shifts, geopolitical tensions, all of these factors feed into the broader uncertainty. We've seen unexpected developments shake market confidence, from sudden banking failures to abrupt changes in monetary direction. This unpredictability challenges the idea that anyone can accurately call the next peak. And yet, investors continue to ask, is this it? Is this the time to move, or to hold back just a little longer? There's also the psychological component that cannot be ignored. In rising rate environments, greed and fear often clash in powerful ways. The fear of missing out on better returns sits side by side with the fear of being too late. That emotional push and pull is particularly strong for holders, those who have already made the decision to stay invested, to not exit prematurely. Their dilemma is different. It's not about entering the market, but about adjusting within it. And that's what makes their decision more nuanced. The expert consensus, if there is one, is that there is no one-size-fits-all answer. Context matters. Time horizon, risk tolerance, and overall portfolio structure all play a role. For some, locking in current rates now makes strategic sense, especially if those rates align with long-term objectives. For others, especially those with more room to maneuver, waiting could be a calculated risk worth taking. The key lies in aligning action with strategy, rather than with noise. That being said, there are signals worth watching. Central bank language is becoming increasingly coded, less direct than before. Analysts have to dig deeper, parsing not just statements, but the tone and subtext of monetary briefings. Any mention of data dependency or persistent inflation concerns can be read as an indicator that rates might still climb. On the other hand, Language suggesting policy normalization or lag effects may hint at a pause or even a pivot. Markets respond instantly to these cues, but holders must respond strategically. Quick reactions can be costly if they aren't tied to a broader plan. And in recent months, we've seen how whiplash policies and unexpected data can lead to brutal short-term swings. In that light, stability becomes its own form of value. Locking in now might provide peace of mind, if not peak return. Waiting might bring rewards, but it also brings the weight of risk. In conversations with institutional investors and fund managers, there's a growing sentiment that we may be approaching a plateau. Not necessarily the absolute peak, but a level where returns are good enough to warrant action. That's an important concept. Good enough. Perfection is rare in finance and often elusive. The pursuit of it can blind even seasoned investors to practical opportunities. Knowing when to move is not always about hitting the top. It's about optimizing for your objectives in real time. Of course, for retail investors, the stakes feel different. The margins are tighter, the buffers smaller. A few basis points can mean a lot more when you're working with limited capital. That's why the pressure to wait, to time it perfectly, can be so intense. But it's also why many experts recommend shifting the focus from rate chasing to portfolio health. What serves your long-term plan? What aligns with your liquidity needs, your income goals, your risk appetite? Another often overlooked factor is opportunity cost. By waiting for a better rate, what are you giving up? In many cases, funds held on the sidelines earn little or nothing. In the hunt for the highest yield, time becomes an invisible cost. That cost adds up fast, especially in environments with daily compounding effects or inflationary pressure. Every day you wait is a day your money isn't working at its full potential. That's a sobering reality, and it's one that's often only fully understood in hindsight. To add to the complexity, some platforms and institutions are now adjusting their offerings in anticipation of future changes. We're seeing teaser rates, limited time offers, and hybrid instruments designed to entice hesitant holders. These products complicate the decision-making landscape, making it even harder to judge what's temporary noise and what's a real signal of rate direction. For holders, this means diligence is more critical than ever. Read the fine print. Understand the lock-in terms. Know the risks beyond the rate. In the end, the decision to wait or not boils down to conviction. Are you confident that higher rates are coming? Are you prepared to accept the risks if they don't? Because while the market loves certainty, it rarely delivers it. What it does offer is a series of choices, each with its own risk-reward profile. And in that structure, holders must navigate based not just on prediction, but on preparation. If there's one truth that history consistently teaches us, it's this: markets reward discipline. The holders who thrive are not necessarily the ones who time it perfectly. They are the ones who stay aligned with their strategy, who act when action is warranted, and who don't allow fear or hope to drive their decisions unchecked. That level of discipline is what separates success from speculation. And in the current climate, that distinction has never been more vital. So, should you wait for a higher rate? The answer isn't clear-cut, and anyone claiming it should be viewed with caution. What's clear is that every choice has consequences. And the best decisions aren't always made at the perfect time. They're made with the best available information, grounded in strategy, and adjusted as conditions evolve. The markets are watching. The signals are mixed. And the next move could define your returns for years to come. Choose wisely.